Time to look at the markets through the eyes of our in-house technical analyst here at TheStreet, Bruce Kamich. Good to see you, Bruce.
Good afternoon.
So you've taken a big picture look at what's happening with the markets, and it's been an interesting year, interesting couple of weeks. Let's take a look at the Dow Industrials first and tell us what you are looking at when you notice this chart recovery from a low, obviously.
Okay. We put in a peak in May, and the market set down until the summers months, August, and we had a double bottom August, September, and the market's come back. So we're in striking distance of new all-time highs again within the market. So this is the kind of time where a technician is going to look at how many stocks within the Dow. It's a small average. We can go through the 30 names pretty quickly to see if we have enough power to get through to new highs.
Before we do that, let's quickly look at the S&P 500 and see if we also see that double bottom pattern, and it looks like we do.
Same kind of pattern, also within striking distance of its highs for the year. It's a broader average, and it's kind of the benchmark for the mutual fund industry.
All right, now let's get to the tricky part of the equation here, where you are going to look at advancers and decliners and try to track some momentum with these rallies we've seen. So explain this chart to me.
Okay. The top part is the cumulative advance decline line. This is an indicator that goes back to the 1920s as a little sidebar of market history. A guy named Leonard P. Ayres had a company called Standard Statistics, and in the day he collected barge movements on the Erie Canal, iron production, advances and declines of securities. And was later merged into a company called Poor's and Company, so it was Standard & Poor's, still around today. But the index shows the breadth of the market. So this is some 3,400 stocks on the New York Stock Exchange, much broader than 30 stocks in the Dow or 500 on the S&P. So it gives a much better reading of the health of the market, digging beneath the surface.
So these trend lines here, what are they telling us?
Okay, so we had an important leg up in the market starting in 2012, and the steepness or the slope of the trend line tells us how strong the movement is, and so does the momentum study at the rate of change in the movement. So we had a very steep movement up in 2012, 2013. We started going sideways in 13 and 14. Okay, so we go up and then we go sideways, and then that kind of can be the foreshadowing of turning down. And the rate of change and acceleration has been slowing throughout the year. So even though we're within striking distance of a new high in the averages, the broad list of stocks is holding back.
We can still hit new highs, though, right? I mean, this can continue for a while. It's just not the healthiest looking market.
No, it has, except for two occasions, led at every major market top by about 4 to 6 months. It didn't lead in 1937. It was coincident. I don't particularly remember that myself. And
I think not.
No. And in 1980, it did not lead at the market top. It's terrible at market bottoms, but at market tops, you find that the rally gets thinner and thinner, so that the big breath is in the beginning of the movement in 2009 and again in 2012. And then as it gets older and older, we find less and less stocks participating.
Okay, Bruce Kamich, good to talk to you again.
Same.
Thanks. I'm Rhonda Schaffler for TheStreet.